Good afternoon, everybody. My name is Kishore Mahbubani. I'm the Dean of the Lee Kuan Yew School of Public Policy, and it gives me great pleasure to welcome you to this lecture. Now, those of you who've been here before through Lee Kuan Yew School know that I only make 3 points in my introduction. So I'm going to say a quick word about the school, then a word about the topic, and, of course, a word about the speaker. And, you know, it's very rare that we can fill this entire lobby. This happens because you have a very distinguished speaker like Martin Wolf. When you have a distinguished speaker like Martin Wolf, there are many distinguished people in the audience, so I can then market the Lee Kuan Yew School to all of you. And I want to say that, you know, we just celebrated our 10th anniversary. We have come a long way, and we continue to have the mission of trying to improve governance in Asia, and that's why only 20% of our students come from Singapore, 20% from Southeast Asia, 20% from China, 20% from India, 20% from the rest of the world. So I know there are many of you in this room who do have also a common goal of trying to improve societies in this region, to make the lives of people better. That's also our mission, so we'll be very happy to work with you in any way that you find it useful. So think of the Lee Kuan Yew School whenever you think of trying to improve governance in this region. And of course, as you can tell, there's a very, 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 very subtle hint to all of you that if you want to make contributions to Lee Kuan Yew School, we welcome it. Now, the second point, of course, this topic couldn't be more timely. As you know, we've gone through rather tumultuous times, especially in the last 10 years, and we're still not sure whether we are out of the woods, both out of the financial crisis that happened 2008, 2009, starting with the Lehman Brothers, and then, of course, that was followed by the Eurozone crisis. And I'm sure there'll be many more crises to come, and I anticipate that Martin is probably going to tell us there are quite a few things coming. So this is obviously an issue of the day, and also it explains why we have this very good turnout today. But of course, this is my third and most important point. The real reason why we have this incredible turnout at the Lee Kuan Yew School today is because our speaker is truly distinguished. Now, I can say a lot about him. That, as you know, he's served on the UK government's Independent Commission on Banking. He was a senior economist for 10 years at the World Bank's Division of International Trade. I'm glad last night that we had dinner with Martin Wolf and some of his friends from the World Bank were there. Tay Kok Peng was there. He's also been a Forum Fellow of the World Economic Forum and a member of its International Media Council. And before that, he was also the Director of Studies at the Trade Policies Research Centre, London. But actually, what's more important is that, as you all know, he writes this remarkable column, and he's produced many books before the shifts and the shocks. I think his real bestseller, if I got it right, Martin, was Why Globalization Works. It is still the standard book on globalization. It's one that I refer to all the times. He's also written a book called Fixing Global Finance, How to Curb Financial Crisis in the 21st Century. He's won many awards for his journalism, most recently the Overseas Press Club of America's Prize for Best Commentary on International News in Any Medium. He's also won the James Cameron Memorial Award, and I can go on and on and on. But let me just say in one line what someone just said about Martin Wolf, which says it all. He is by far the single most influential financial commentator in the entire world. And for that, it gives me great pleasure to welcome Martin to this podium. Martin.
First of all, thank you very much for that extraordinarily warm welcome, Kishore. It's an immense pleasure to be here again. I have lectured here before, but I can't remember exactly when, but it's quite a few years ago. And it's always a great pleasure to return here. And I hope we will have an interesting and engaging evening. I was just trying to work out who said that extraordinarily over-the-top remark. Must have been someone I paid. It was Larry or Ken? I don't know. Anyway, somebody with no real judgment. Anyway, it's a great pleasure to talk about my latest book, which might be seen as a follow-on from the last one, which was written just before the crisis, and then we had the crisis, which was worse than I thought, so I had to rethink it all. And this is the result of my rethinking. The book is an attempt to set out an overview of what we should think about this extraordinarily important event in economic history, in financial history, and in, I think, international relations as well, because it's changed the world. And what I think is special about the book, different from all the immense number of titles on the crisis, is that it sees this as a part of a global crisis. It links it to the Asian financial crisis, which many of you, I think, will remember, and as part of a global financial system. The vast majority of books basically treat this as if it were, for very obvious reasons, essentially an American event, only of interest to Americans, because it's written by, those books have been written by Americans, and they're not really aware there's anywhere else in the world. So a characteristic that I'm sure you recognize is familiar of all immensely large and powerful countries. I have a different perspective. One of the advantages of being in a relatively small country with declining powers has a more global perspective on these matters, I think. And working for the FT has, of course, been an immense privilege in this regard in terms of the people I speak to and the contacts I have. So my book, in addition to looking at the American crisis, looks in enormous depth at the Eurozone crisis and sets in this global context. So what I'm going to discuss, this is a big book, I apologize for that. It's not as big as it looks. There are about 350 pages of text and tables. The other 150 pages are footnotes and references and index, and really you don't have to read all that. But it is more an academic's book, I have to admit, than a journalist's book. It's not full of juicy stories. It's full of charts. So it's perhaps appropriate that I'm in this sort of environment. I'm going to divide my remarks into two parts. I'll get through it as quickly as I can. The first part is my view of what happened, what we call the shifts, what I call the shifts, the changes in the whole world economic system, in the financial sector, and the shocks, which are obviously this wave of crises. I should say, obviously, we're not through it yet. There is a recovery now in the US, not an exceptional one. In fact, the weakest recovery the US has had pretty well ever. The Eurozone, pretty obviously, is not recovering. It's not in crisis anymore, but it's not recovering. And we don't know whether it will relapse. And there are some interesting other developments in the world, which I won't have enough time to discuss. But this environment of crisis is still with us. And then I'm going to talk a bit about the solutions, the lessons that the policymakers have learned, and the extent to which those lessons are going to work. I mean, that's really pretty important, isn't it? So my first point is this was a big failure. It was a failure of institutions, of regulatory institutions and monetary policy institutions, and more importantly, for me, as an economist, an economic commentator, it was a failure of economic understanding. And the big mistake, I think I may come to this again, is not that people fail to forecast it. To some degree, if you can forecast precisely when a crisis will happen, it's not going to happen. That can be the very fact that you know that something's going to happen is likely to lead, or almost everybody agrees something that's likely to happen. It tends to mean that it won't happen. I think the real failing was actually much deeper, which was to the vast majority of people looking at this, and I think to a significant extent this is true of me, a crisis on the scale that happened was actually inconceivable. And that's different from its merely being unforecast. It was something we didn't understand. And before the crisis, we had what I refer to in the book as the old orthodoxy, as opposed to the new orthodoxy of today, which is in essence, in the developed world, in the dominant economies, and particularly in the US, that we had inflation targeting, and inflation was kept well under control. We had a deregulated financial sector governed by self-interest, we would have a stable economy. And indeed, they praised exactly the consequences of this combination in referring to something called the Great Moderation. And I quote at the beginning of one of my chapters a speech by Ben Bernanke, obviously an immensely important and intelligent figure, a speech he gave in 2004, in which he said we've got this tremendous success of monetary policy, this remarkable stability, which we call the Great Moderation, and to a significant extent, I believe we did it. Okay, that's what he thought 3 years before everything blew up. And the fact that this turned out to be wrong, that this perception of how we should run economies was wrong, is a gigantic shock to macroeconomics as a subject. And it's the second such shock. The first big shock, which I also lived through just after I'd studied, was the great inflation of the 70s, which sort of blew up naive Keynesianism and led to monetarism and all the rest of it since then. And we're now, I think, inevitably in the second process of adjusting and learning from experience. And I think I'm going to argue that the way of thinking about this is that there were macroeconomic shocks, perhaps I should call it macroeconomic shifts, and financial shocks. These are interconnected. I'm going to simplify, and I'll add a couple of points. The macroeconomic trigger, I argue, for the whole process was a profound shift in the world economy that occurred after the Asian crisis, completely understandable change, which was followed by a very big shift in emerging economy policy, which made, actually, for the first time, the emerging world as a whole, if you aggregate it whole, a very, very large capital exporter. And it shifted the global pattern of savings relative to investment. There was also an investment cut in quite a number of countries around here, a huge increase in savings, particularly in China, also later in the oil exporting countries, and a big decline in global real interest rates, which is a very remarkable phenomenon. And this then was associated with the rise, along with a few other changes, of very large global imbalances, which led to an endogenous monetary response in the developed world, which basically accommodated these imbalances with a huge credit expansion. And there were also, and I have this discussed in my book, but I don't have time now, some important changes in income distributions within our economies and in the propensity to invest in our economies, which further exacerbated this global savings glut condition. And further increase the extent to which monetary policy became extremely expansionary in the early 2000s, not only in America, but also in Europe, encouraging European bubbles. And meanwhile, there was a financial trigger, which was in that context, I've already said, credit creation was the vehicle for handling this new world of saving gluts. This credit creation created endogenous fragility in the financial system, financial innovation as the economy liberalized, as the financial system liberalized, and this triggered what the Hyman-Minsky cycle, the process of mania, leading to mania, with Minsky's great idea, which I think is central to this way of thinking about what happens to a financial sector in these conditions, which is that stability destabilizes. A world which seems stable, where there's a trigger which starts off a process of boom, a bubble, and then boom, is one in which the process of the financial sector itself destabilizes unless it's stopped, and there was no reason for the regulators to stop it because they wanted this booming growth to make their economies function. The Eurozone is embedded within this crisis, but it's also the global crisis in miniature, if you look at it. I'll come to this in a moment. I've described this as a bad monetary marriage. There are highly divergent preferences in economic structures within the Eurozone, radically incomplete institutions. In the honeymoon period of the first few years of the Eurozone, Basically, everybody got what they wanted. Germany had a rapidly growing surplus. The countries in the south, particularly Spain, had a huge domestic credit boom and housing boom, which triggered an enormous rise in real income. So everybody was very happy. But then the crisis hit, all the capital reversed or stopped and then reversed. Members found themselves unhappily married. One side complained about the other's profligacy, and the other side complained about the former's meanness. And that's basically where we've been ever since in these creditor-debtor relationships. It's important just to, they cannot make it work well, and they can't break it up. Breaking it up is too difficult. There's quite an interesting and important point, by the way, which is asymmetry, an absolutely core asymmetry in the world, which is that within the Eurozone, because of the nature of the institutions of the Eurozone, the creditor countries determine the nature of the outcome, the resolution of the financial crisis. So in the Eurozone, it's the creditor countries. In the world as a whole, the dominant debtor determines the resolution. And the dominant debtor determines the resolution, and everybody else complains about the way it determines the resolution because it owns the printing press. And the question is, in these crises, it's very, very important. In a crisis, there's only one safe asset left, which is money, the money that everybody's willing to hold. Okay? In the Eurozone, the institution that creates the money that everybody was willing to hold, which solved the crisis to the extent it could, the ECB, is more or less effectively controlled by Germany. In the world, the relevant printing press is controlled by the US. And that changes and shapes the response. And, of course, it's why everybody else in the world absolutely hates this outcome, but tough, that's how it is. Now, let me just go briefly through how some of the story, which I think is really rather a remarkable story. So first I'm going to talk about the trigger, the real house price bubbles and global real interest rates. This I hadn't expected until I looked for it, and it surprised me. One needs a measure of global real interest rates on safe securities. The simplest one is to take it from an open economy with AAA rated assets, as they then were, which sells index-linked bonds. Index-linked bonds are perfect measures of real interest rates, and the UK has been doing this for a very long time. You've got the data back to the mid-80s. And if you track it against the US and other countries that have issued such bonds more recently, there's almost a perfect relationship, which is exactly what you would expect, because the bonds of highly rated liquid assets of countries which are open to the capital account should basically yield the same amount. And this is quite interesting because you basically see three stages in this story for the UK. First, before the Asian crisis, before 1907, the real interest rate was about 4%, which is what you would expect in a booming world. Then there was the Asian crisis, and absolutely coincidentally, the real interest rate halved from nearly 4% to 2%. That's a massive shift in real interest rates, and it occurred in a year and a half. And it's perfectly coincident with the Asian crisis, and I can't think of any other reason for it. And this, as you can see, then continued to the late 2007 at about 2%. Then there was the global crash. There was really a savings glut. We moved from a semi-global savings glut to a massive global savings glut in the crisis. That's the definition of a depression slump situation. And real interest rates went down to zero, which is where we are now. We have been in a zero real interest rate world on safe assets for 6 years. That's an absolutely astonishing fact. It's an absolutely astonishing fact. And this is non-monetary. I don't see any monetary explanation for this shift on this scale over this time. There are real processes at work. And the second point to take from this chart is I put the real house prices for UK, Spain, and the US. These are the three most important house price bubbles in the West associated with the crisis. The UK is at the top, green. Then the Spain and US are immediately coincident, and you see the US started turning in 2006. Spain and US crashed, and the reason they crashed is that unlike the UK, they responded to this massive rise in the price of real assets which is, I think, clearly triggered by this global fall in real interest rates, by building immensely more houses, and that ultimately crashed the market. It wasn't a sustainable bubble. In the UK, we didn't, so the bubble didn't crash as completely. It was a relatively modest change. This is what happened to I've said, the global capital flows, the net capital flows across regions, starting just before the financial crisis in Asia in '96, and you can see how massively they expanded relative to world GDP between 1996 and 2006. What emerged was basically three huge surplus regions: East Asia, China and emerging Asia, which is yellow. The green bloc, which is old industrial countries, mainly Germany and Japan, and the oil exporters. And there were two regions that emerged as the capital importers. They took the capital from net. They were the US, which absorbed 70% of it, and peripheral Europe. And every single country in that second group went into crisis, and I argue in the book at length, this is not an accident, this is exactly how this worked. The capital was absorbed through a crisis-creating process. It wasn't efficiently invested, it was invested or wasted largely in consumption and housing bubbles, housing construction, useless houses, it turned out, in these economies driven by credit boom. An important element of this new world order that emerged after the Asian crisis was the massive accumulation of foreign currency reserves, official capital and capital outflows, these are essentially, by predominantly emerging economies as a way of shielding themselves against crisis, to build up foreign currency reserves, go back to export-led growth, keep the exchange rates down. And this explosion is quite staggering, from much less than $2 trillion back in 1997 to $12 trillion today. I haven't even put in the sovereign wealth funds. And of about 45% of that accumulation is China alone. That's the blue block at the bottom, as China accumulated reserves going from $100 billion to $4 trillion today. But it's not the only country. This is a net capital export, and predominantly, inevitably, into US liabilities, because if you're trying to buy reserves, you basically buy you end up, two-thirds of global reserves are in dollars, so of course they end up tending to buy the liabilities of the US government. Meanwhile, domestically, as I said, with these excessive funds coming into the US, I'm focusing particularly on the US, this was itself contractionary. It led to an appreciation, a strengthening of the real exchange rate, rapid growth of the external deficit. This is contractionary in terms of demand. The central bank responded with a very aggressive monetary policy, which you can see turning towards the end of the 90s. You can see a clear uptick, and they were very comfortable with the massive liberalization of the financial sector, which is shown in this enormous growth of financial sector debt, which is the green area, which really explodes upwards. And the other big accumulation, which you can say again see a clear uptick in the late 90s, is of household debt. Corporate debt didn't rise so much. But you can see that over the period as a whole, really a massive expansion in leverage in the American economy, which blew up in the crisis and has since declined appreciably, not so dramatically, but appreciably by the end of last year. So this is annual data, and you can see there's been a real contraction, but it's not gone. And one final thing happened, which I think is also important as part of this very complex process that I tried to describe, the way I think of it, is a massive leverage within the core financial sector. And here, this happens to be data, I don't have comparable data for the US, from the UK. The UK also has gigantic banks, internationally open banks. One of the things that many people might not realize, it sounds very weird, but the aggregate balance sheet of the UK banking sector was as big as the aggregate balance sheet of the US banking sector before the crisis, because of these huge global banks. And the really interesting thing here, that's why this chart is so startling, is if you just look at the the line coming up from the bottom, that's the measure of the aggregate leverage, the ratio of the total balance sheet to equity of these banks. And you can see it started off in 2000 about 16 times, and by 2008 it'd gone to nearly 35 times. So the leverage basically doubled over this relatively short period, all in about 4 years. And it happened, and this is the fascinating thing, at the time when the riskiness of the assets, the risk weights are just the value of the assets, to tell you how much capital you need, was collapsing. So basically what the banks were saying to themselves and to the accountants and to the regulators is, we don't need any capital because our assets are so safe. And they're getting so safe so quickly, in those just 4 years, we can double leverage. And so that's why all the banking sector of the Western world, the whole banking sector, was telling the regulators in the summer of 2007, when the crisis started, that the banking system had never been as well capitalized. And it's not because it was really well capitalized, it's because they'd basically written down the riskiness of their assets to such an extent that they didn't seem to need any capital. And that was the endogenous process which the rate moderation caused, because they were quite right. They hadn't had any losses recently. Stability destabilizes. Then, of course, the crisis hit, and we moved into the present period, or the post-crisis period. The crisis hit, there was a massive panic in the financial sector, possibly the biggest panic ever in the late autumn of 2008 and early 2009. This led to this massive series of interventions to save weak financial institutions all across the West, not just in the US, in Britain and Netherlands, Germany, and so forth. And it led very, very swiftly to a massive loosening of monetary policy, which is the experience we've had here. And here, this chart is fascinating. So I put the short-term central bank intervention rates going back to 1994, the 4 biggest developed country central banks, the Fed, the Bank of England, the Bundesbank, ECB, and the Bank of Japan. And you can see we've all ended up at near zero. The highest rate of any of them is 0.5%. We've been near zero. The ECB resisted very, very hard to get there. You can see the green twitch upwards, which is one of the most insane episodes, I think, in monetary policy, when they decided to tighten monetary policy because they really wanted to. They really wanted to. And when they finally realized what was happening to their economy, the deflation process now at work, they collapsed too. They've now gone down to essentially to zero. And the reason I put this long period in is you can see there a country that has had near zero rates for 20 years. And that country is Japan. Okay? They've had near zero rates for 20 years, and we've all joined it. Okay? So the world has become Japan in the developed world. But remember, the developed world, even today, is diminishing in importance, but at market prices, it's more than about 60% of the world economy still. Roughly, between 50 and 60%. So this is an astonishing phenomenon, and the really remarkable thing about it is that it didn't begin to be enough. In spite of offering the banking sector basically free money, the banks wouldn't lend. They were too shocked. They didn't think there was any good credit risk. So the central bank decided to expand their balance sheets. So this is what's happened to the balance sheets of the Federal Reserve, the Bank of England, Bank of Japan, and ECB. You can see in the Bank of England and the Fed have both expanded their balance sheets to 25% of GDP, which is basically unprecedented. Very remarkable how similar. The ECB did expand its balance sheet from about 10% to 32% and then allowed it to run off. And they've now decided very publicly, very explicitly, this was a terrible mistake and they're now going to reverse it. So the ECB is now in the expansions phase. The Bank of England and the Fed have stopped expanding, but they're not contracting yet. And the Bank of Japan is in completely other space. It's now, I haven't got the very latest announcement, but the Bank of Japan's announcements imply that the ratio of central bank assets to GDP will be above 80% of GDP fairly soon and continue on upwards. So we are in an episode of quite extraordinary monetary policy, absolutely unprecedented. completely unprecedented in response to the total collapse of the financial sector. And is this leading to the hyperinflation everybody feared? No, it isn't. It's leading actually to continued deflation. So I think it's important to understand what an extraordinary world this is. This is balance sheet deflation really at work. If you look at those policies, they have been relatively successful in the US and so far completely unsuccessful in the Eurozone. Or not completely, that's unfair. They've stopped the crisis. But in terms of recovery, the stories are utterly different. So this basically shows you the contrast between the US post-recovery, post-crisis, and the Eurozone. The main reason I think the US has done better is they cleaned up their financial sector much more quickly, much more aggressively than the Europeans did. They, as usual, they allowed a lot of default. They allowed lots of people were pushed into bankruptcy. It's been a terribly brutal process, but they actually did have a debt reduction that hasn't happened in Europe. And of course, they could coordinate, for at least briefly, fiscal monetary policy to start the boost. So the US, both GDP and domestic demand, has expanded not quickly. It's about 2% a year. It's a very weak recovery by US standards, but it's at least a recovery. If you look at the Eurozone, the green line is GDP and the red line is real demand. You can see that real demand is, in the second quarter of this year, was 5% below the pre-crisis level. That was more than 6 years later, it was still 5% below. This is basically a slump. Incredibly weak recovery, and GDP essentially the same. The fact that the GDP line has done better than the demand line is basically because the Eurozone has improved its current account balance dramatically, of course at the expense of the demand in the rest of the world. But the Eurozone story there is very, very depressing. Now, if we try to put this crisis in the long-run context and try to ask ourselves, well, what does this mean in terms of the growth of these two major economies? Well, this is the answer. It's a very simple answer. I have the chart in my book. I've got US GDP going back to 1950, and that's the red line. And I fitted a very simple exponential regression line, trend line, to this from 1950 to 2007. That's the blue line, and then I extrapolate forward what would have happened if the US had continued on that standard line all the way up to today. And the green line shows, and it's on the right-hand side, the deviations from that trend of actual GDP to that trend. And you can see there were some oscillations up to now, positive oscillations, particularly in the 60s. We know the 60s were a great boom period, but fairly close to zero. And today, or this was actually goes up to the second quarter of this year, GDP is 18% smaller than trend. That's an enormous slump. So the losses in the US are absolutely gigantic. And now let me turn to the Eurozone story. As I said, I've already shown you the global imbalances. These are the Eurozone imbalances. It's a not dissimilar picture. It's very interesting how similar it is. As I said, it's the world in miniature. The red line shows the overall balance of the Eurozone. It's been roughly in balance till recently when it moved into this very big surplus, as I've shown you. And in the early years of the crisis, before the crisis, there was a huge credit boom in the south, particularly in Spain. Spain dominates that blue rectangle, which is the capital importers. The capital exporters are dominated by Germany and the Netherlands. The other creditors are mostly the Netherlands. These deficits exploded in response to this basically destabilizing booms in the south and extreme credit retrenchment in the north, fiscal and credit and very tight credit policies controlling and the unwillingness to borrow. And we got these huge imbalances. Again, it blew up in 2008. The credit dried up, and the countries in the south all went into deficit, all went into depression, slump. It was a massive cutbacks in imports. The whole Eurozone went into surplus. Almost every country went into surplus, and we ended up with this period of absolute demand collapse, which I have shown you already. That was this is essentially a sudden stop. Anyone who's been familiar with emerging country and developing country crises will be familiar of this. But the immediate response of this crisis was a massive spike in spreads in between German rates and rates in these other vulnerable countries after a long period when ludicrously the spreads had all collapsed because the markets had completely underestimated risk before the crisis. There was a spike up I've just shown you Portugal. I haven't put Greece in, it gets just too big. Portugal, Spain, Italy, Ireland, and you can see a series of policy interventions by the ECB, which I've indicated. The most important is the OMT, the outright monetary transactions of the summer of 2012. That really broke the panic. It was when the ECB said we will be a lender of last resort to governments, and this has brought spreads now to very low levels. So the crisis phase is gone, and you just have this chronic economic malaise. That's the great success of central banks. Again, it's the central bank involvement. However, the ECB, the Eurozone now has this very, very big problem, despite this massively expansionary monetary policy they now have, that inflation is far too low. So I put in the core inflation of a whole slew of important countries, Germany and the countries trying to restore competitiveness. And the crucial thing you can see is some countries have negative inflation, they're in deflation. Greece, for example, is in deflation. Spain is now in deflation. Portugal is in deflation, very mild. All the other countries are clustering close to 1%, including Germany. And that means all the countries that are trying to gain competitiveness against Germany are basically being forced into deflation. And because they're being forced into deflation and their growth is very low, the real burden of their debt is rising. And that almost certainly means, in my view, that there will be another debt crisis to come. So the process isn't over. Now, I thought I'd put in one additional chart, and this is China, because I think it's a fascinating part of the story of this successive wave of crises. I've already indicated that in some profound way, the response to the Asian crisis triggered processes that led to a crisis ultimately in the West, and then the response of China to the Western crisis triggered processes that is creating very large problems for the Chinese government. It's a fascinating spiral of crises. So if you look at China's economy, and this is the structure of spending in the Chinese economy, going back to 2000. So the yellow bars is household consumption as a share of GDP. The green is government consumption. The light blue-green is investment, and the bit at the top is net exports. And you can see that from 2000 to 2007, there was a huge expansion of investment relative to GDP, a giant expansion in net exports relative to GDP, and consumption, particularly private consumption, contracted really remarkably dramatically. I've never seen a pattern like this in any economy. This is Chinese data, so they presumably know what they're talking about. Then the crisis hit. The crisis destroyed net exports. There was a very quick adjustment of net exports because external demand went. The Chinese government wanted to sustain demand, so they took the investment rate of 42% of GDP and they turned it into 48% of GDP, which is the highest rate of investment of any country, as far as I can see, ever. Certainly any large country, maybe one or two small ones. And so they took the disequilibrium in their economy, already massive, and made it even bigger. And much of that, as you know, was associated with a huge credit boom. Credit almost doubled in China in 4 or 5 years. And much of it went to real estate and to real estate construction. And a lot of that is going to turn out to be bad, or quite a bit of that's going to turn out to be bad. But even if they can manage the financial crisis elements, which I think they will, this is not a stable pattern. So they basically have to reverse the structure of their economy back to where it was in 2000. They have to get back to that sort of structure. The investment rate shouldn't be 48%. In an economy now growing 7% a year, it should probably be 35% of GDP. And that means there's another stage of real restructuring, radical restructuring of an incredibly important economy ahead of us as this cycle goes. So then that leads me to the second part, perhaps 5-10 minutes. What are the solutions to all this terrible mess, this endless spiral, this cycle of bubbles and bust, which we seem to have got locked into over the last 20 years, this interaction between huge global macro forces and our very defective financial system, again, which you all experienced in the Asian crisis. I mean, essentially, the Western crisis is the Asian crisis on a much bigger scale and more internal. Okay. Well, we've got a new orthodoxy nowadays. This is what the Western policymakers think is the right way to manage their economy. So it's an updated version of the old orthodoxy. There's no fundamental change in macroeconomic thinking. The same reliance on monetary policy is the dominant tool. The same belief that fiscal policy should be basically balanced in all circumstances. And we have much the same financial system. We have inflation targeting just as before with the same inflation target. We haven't raised it or lowered it. I think there was a strong case for raising it given the difficulties we've had at the zero bound. There's been no large-scale debt restructuring. So if you look at our economies, even at the US, if you remember the figure I had earlier, yes, debt has fallen, but it's only back to 2002-3 levels. That doesn't give you much of a cushion to expand through credit again. There's no adequate coordination with fiscal policy. We haven't used fiscal and monetary policy together well, except in the immediate aftermath of the crisis. We have re-regulated the financial system, and we do rely on macroprudential policy, some idea of systemic oversight of the whole financial system. And the question is this going to be enough? And I suggest that there are two huge challenges. First, how do we get global demand without credit bubbles? That's the crucial thing. How do we get demand without credit bubbles? And how do we get a more stable financial system? So, as I said, we have the same financial system, tighter regulation. We hope for speedy resolution in cases of difficulty to avoid bailouts. But the regulation structure, and I'm going to come to this moment, is unbelievably complex and tortuous. Our banking sector is more concentrated before. I don't know how many people realize, but the world's major banking sectors are now more concentrated than before, with more too big to fail banks. The banks are still incredibly highly leveraged. And yes, they're not 35 to 1 now, but they're still 20 to 25 to 1. So that's an incredibly small cushion against losses. We still rely overwhelmingly on what has proved to be a hopelessly unreliable risk weighting of assets. That's still the core of the Basel process. And of course, it's still global, which means that an enormous amount of what the banks do really can't be overseen by any set of regulators. Nobody can regulate JP Morgan. I'm just giving you an example, because its balance sheet is everywhere. Even the US authorities, it requires the cooperation, the most intimated cooperation of every regulator in the world. That's not the way the world works. It's an illusion that this institution can be regulated. And in fact, since Jamie Dimon, who really is a very clever person, wasn't able to pick up what was going on in his own bank in this famous London Whale story, makes it pretty clear that no regulator could have. So I think you have to say that this is I'm very skeptical about this. Now, this is a lovely little quote which I've taken from a wonderful paper by Andy Haldane and Vasilios Madouras, which is at the Jackson Hole Conference of 2012. You can look it up. It's called The Dog and the Frisbee, and it's the most amusing paper about bank regulation ever written. So you'll all love it. It's just wonderful. And its basic argument is that everything we're doing is crazy. And I would like to point out that Andy Haldane was the head of bank regulation in the UK, so he knew of what he was speaking. So what he said is, as of July this year, that was 2012, 2 years after the enactment of Dodd-Frank, a third of the required rules under Dodd-Frank had been finalized. Those completed have added a further 8,843 pages to the rulebook. At this rate, once completed, Dodd-Frank could comprise 30,000 pages of rulemaking, and that's roughly 1,000 times larger than Glass-Steagall. Dodd-Frank makes Glass-Steagall look like throat clearing. By the way, the Europeans are going to get to 60,000 pages. I cannot believe that this structure regulation is workable. It's going to miss things, and it's going to drive people completely, utterly crazy, and they're going to spend almost all their life trying to live within the letter of the regulations without obeying the spirit. So the regulatory system we adopted is essentially a reflection of the fact we've got essentially the same system as before, but we don't trust it. That's really the worst possible world. We've got this exactly the same system, but we don't trust it. And that's the way the West is managing the financial system, which is, of course, remains today at least, the most important financial system in the world. We also hope that we will manage this system well with what's called macroprudential policy, which is ideally a way of protecting the financial sector from the cycle and the cycle from the financial sector. So managing the interface between the two to avoid the sort of process we saw before. But that too will raise some very difficult challenges. It's very difficult to judge macro interventions in the financial system. A lot of the judgments are going to be enormously politically unpopular. They basically involve telling whole classes of people whether they can borrow or not. There's going to be some very big technical problems because in many cases the macroprudential policy is going to conflict with the direction of monetary policy. I discuss that in more detail in the book. And there are inevitably going to be unintended consequences as the system tries to arbitrage around the macroprudential regulation through the shadow banking system, which is going to grow very rapidly. So my view is that instead of this immense complexity, we would have done much better simply to insist on much higher capital and less regulation. The banks need to have a big enough cushion to survive pretty well any event, and I discuss the literature on that and come to the conclusion that the least bad capital ratio is probably about 10 to 1. And if we had a banking sector that capitalized, we could get rid of a lot of this extraordinary junk. The other big thing we have to do, and this is sort of my last main point, is deal with the underlying demand problem in our world economic system as I've defined it. The inability to generate adequate demand in the world economy over the last 2 decades without destabilizing and ultimately destructive credit bubbles. But we certainly not managed this problem yet in the developed countries. We are still desperately trying to regain growth, both on the supply side and the demand side. And obviously a very big question is, why has the crisis been so costly? And I think part of it is that the pre-crisis trends were themselves unsustainable. They were masked by the credit boom. The crisis damaged economies, particularly confidence. These damage seems to be very long-lasting. The crisis bequeathed a huge debt overhang, which we've only just started to deal with, and policymakers adopted some very bad post-crisis policies, especially in the Eurozone, with a one-sided focus on austerity. So we've made a pretty fair mess of it, and that's why our recoveries are so weak. The solutions. In the short run, right now, I think the least bad solution is higher public investment. The public sector is able to borrow in many countries at exceptionally low rates, and we could even use better cooperation between monetary policy and fiscal policy, including Milton Friedman's suggestion in A Slump of helicopter money. Adair Turner has a very nice column today in the FT recommending such a policy. We need much faster debt restructuring, especially in the Eurozone, actually going out there restructuring debts, and that will be this combination of faster debt restructuring and more public investment will be the best response to what Larry Summers calls secular stagnation. In the Eurozone, this is particularly severe problem. Turning the Eurozone as a whole into Greater Germany is failing, and the reason ultimately is Germany is an export-oriented economy. It depends on foreign demand. The Eurozone is 3 times as big as Germany, and it's too big to depend on foreign demand. It just doesn't, the world can't generate that demand. And of course, the other European countries don't have the competitiveness Germany has, and they're not going to develop it. They don't have that export sector. They need to turn it into an adjustment union, and a part of that adjustment union means they hit the inflation target. And if they're going to hit the inflation target of 2%, Germany's inflation has to be 3 to 4%, and they're not getting anywhere near that. They're not getting the traction they need. In the long run, I remain of the view that in an open global economy, it's the argument I made in both my previous books, the rational way for capital to go is from rich countries to poor countries. That's not going to happen without a fundamental change in the insurance mechanisms for developing countries. And the least bad way, I'm not saying it's going to happen, it isn't, is a much bigger IMF with a radically different governance, with the emerging countries having a much bigger say. Otherwise, the insurance mechanisms that the emerging countries themselves are creating is the second best. But I think a situation in which the emerging world goes on being a huge net capital supplier to the developed world, which then wastes it comprehensively and creates crises, is completely crazy. On the domestic side, we have to deleverage our economies, and that means we have to move away from tax subsidizing of debt. We need equity sharing contracts rather than pure debt contracts, particularly in housing finance. And I actually discuss the idea of 100% reserve banking as one possible way of going with higher equity ratios in genuine banks to make the system more sound. So I've covered a lot of ground in this talk, only a small part of the book, I have to say. But my conclusions are basically as follows. This is obviously a massive crisis, and it's not over. And it has a huge shadow and echo. It's created lots of destabilization of the Chinese economy too. And I think people have underestimated how severe a problem that is for China. I think it's manageable, but it is a big problem. This was caused by the interaction, and I haven't even talked about inequality, the role of the financial sector, on all that, because that's also important, but I don't have the time, between macroeconomic forces and financial fragility. The new orthodoxy is an improvement on the old orthodoxy, but it's likely to fail for reasons I've already indicated, because it neither provides a route for demand which doesn't involve more credit, and nor does it create a really robust financial sector. We need to make the macroeconomy domestically and globally much more balanced, finance much less fragile, and so to escape what I call a concatenation, a chain of global credit bubbles. That's the challenge. That's what I set out to discuss. I don't say that I've solved it, but I think that's pretty clearly the issue. And till we do, we're going to have more of this. I can't predict where the next will be, but we're going to have more of it. Thank you for listening.
So, what's for my first question, you're a layman, you have a little bit of money, a few $1,000s. What do you do? How do you protect yourself?
Well, one of the consequences of the monetary policies that have now been pursued is, and that was the policy, that was the intention, was that they've driven the prices of all risk assets upwards. So that the real return, the prospective real returns on almost all standard, easily tradable assets are now pretty low. So the real return on government bonds, the highly rated government bonds, is zero or near zero. In the UK-US case, the real returns are now about zero. If you believe that the central banks of Europe and Japan will achieve their targets, then the real returns on bonds in those countries vary between -1 and -2. So that's not a great investment, right? So the stock markets are very high. And it's a basic fundamental proposition which is very well supported by empirical work by Bob Shiller and others who got a Nobel Prize for it, that when prices are high, stocks are high, prospective real returns are low, not only because price-earnings ratios are high, but because prices are more likely to fall than to rise. So major equity markets don't look very attractive either. There are some housing markets that have corrected, so I think if you can buy some US property, I think that's been rather a good buy. in recent years. There was a brief period, no longer, just after the crisis, when British property was rather a good buy. That's why every rich person in the world seems to have bought a house in London. But that's no longer true. So I think the best you can do in the major developed countries is to preserve your capital, and you can't do that by buying bonds. You have to take some risk. Now, beyond that, then you're talking about special situations. And you have to pick markets correctly. There is still obviously great long-term potential in emerging economies, and it's if you're there's obviously some risk associated with them. That's what emerging economies mean, but they ought to return relatively well in the long run. But it's likely to be a volatile ride. If you look at the stock market indices for emerging economies over the last 20 years, they've been up and down. And property tends to be similar. You have to choose where you are, where you can buy, where you will. So the view I hold is average real returns on the major classes of assets now are extremely low. And if you want strongly positive real returns, you have to be prepared to take a lot of risk. And at the age of safe high returns is not the age in which we happen to live. I would love to be more cheerful about this. But that seems to me not only where we are, but it's of course where the central banks wanted us to be.
Okay, questions on the floor, please.
Center on Asia and Globalization, Lee Kuan Yew School. Thank you very much for your very comprehensive and brilliant analysis how global savings glut and global imbalances leads to crisis. I just want to ask questions pointing to two recent developments in Asia. And one is, as you know, the policy pursued by the BOG, the qualitative and quantitative easing. Due to the policy, the Japanese banks have too much money, basically. And what they're doing now is coming to Asia, and in particular to Southeast Asia. What they're saying is that they can manage risks better. Okay, I'm not sure whether that's really the case. So what's happening is that the easy money from Japan is now flowing to Southeast Asia. That's the one recent trend. As a result, the mega banks in Japan are becoming the biggest syndicate loans providers in this region. That's the first trend. Okay. The second trend is, as you know, as we all know, that China has recently established a new infrastructure investment banks. And that's an attempt, I would say, to channel the excess, the very high domestic savings into project financing in Southeast Asia and in Asia in general. That's, again, a capital flow from China to this region, to this part of the world. The problem is that the financial markets in Southeast Asia are massively underdeveloped. And if I listen to your story today, I do see a parallel of this recent development, how capital is flowing from Japan, from China to this part of the world, or will flow increasingly more in the future. My question is whether you see a potential of a crisis, and what's your advice to the financial regulators and watchdogs in this region? Thank you.
Okay, I think both observations are very perceptive and convincing. And it does remind me, but haven't followed the recent developments as closely as you have, of what happened before the Asian financial crisis, which was a very similar period, you will remember, in the mid-90s. And if I remember correctly, immediately before the crisis, Thailand had a current account deficit of 8% of GDP. And the Korean banks suddenly opened up to world flows and made some really quite astonishing investments. And then there was a reversal. And Indonesia too, and this led to a horrendous crisis, which was the worst crisis till this one. So I think what's going on is that the Japanese central bank, I don't think I have time to go through all the aspects of their policies, is deliberately creating a structure designed to weaken the yen and encourage capital exports. That's clear. That's intentional. well, it's not, you will not find a speech by the Mr. Kuroda saying that's the intention. No, but it's a completely predictable and inevitable consequence of his policy, and the results are quite welcome, because one way for Japan, clearly, to raise inflation is to weaken the yen. In fact, it's the most powerful single tool, I think, and it's working. I mean, the yen is significantly weakened. And in this environment, it becomes very attractive to purchase foreign assets, and the hope that they will rise in price. And in any case, the return on domestic assets, I've already told you, JGBs are reasonably yielding 0.4%. Nobody in their right mind would buy Japanese government or any bonds in Japan. Even equity prices are boosted. So yes, this is going to happen. And I think it is clearly true that small, relatively small open economies, and compared to China and Japan, all economies here are small, are going to be overwhelmed by capital inflows. I expect there to be a round of emerging country crises in the next 5, 6, 7 years. I've actually more expected to be Latin America, because there's a lot of capital inflow has already gone into Latin America during this, and the reversals going back to the US are going to be very messy. So I've been thinking about what's going to happen in Brazil, particularly, possibly Colombia, possibly Mexico. In the longer run, the risk could happen here. I tend to think that though it's very, very hard to manage this, if I were in charge of an economy, thank heavens I'm not, like I'm Indonesia or whatever, I would think very seriously about capital controls. I mean, the truth is you can't risk this. Certainly, they have to look very, very carefully, if they don't want to do that, at where the money's going, and ask themselves, are the structures of wherever they're going, the financial structures, such that if it reverses, we could cope with it relatively easily. My previous book, Fixing Global Finance, had a lot of discussion of this and what some of the issues. And one of the most important is that you borrow in domestic currency. If you borrow in foreign currency, so if they're borrowing in yen, particularly to finance, or RMB, to finance domestic assets, you've got potentially a massive crisis in front of you. And I think people have to be very, very careful. But your description of the situation, this is where the next crisis will come from. And how China resolves its crisis now, and how far it resolves it through capital outflow of the type, is going to be immeasurably important for the world. And I think that's one possible outcome, that Chinese capital outflows will expand very, very dramatically. And it'll be very interesting to see how China manages that. It's something completely new for China. It's not something they've ever done before.
Next question. Yeah.
Thank you. I'm Joshua Green. I'm a visiting professor of economics at SMU. First of all, thank you very much for your book. I've recommended it to all my students and encouraged them to watch your speeches online. My question is as follows. I took away as one of the things in your book that you're very anxious about central banks trying to reignite demand basically by pumping more money into banks and then having the hope that they will again lend it out, which could lead to another big credit bubble. So my question is, can you comment on two alternatives? Say a little bit more about programs for big debt restructuring, in particular for households, and secondly, a little more about the helicopter money. And I'm asking because as one who does not know all the laws, by all means, it could be that a lot of central banks don't have the authorization, for example, to stick money into household bank accounts, which might be a way of offering helicopter money. So any observations you have about those two alternatives would be much appreciated.
Yeah.
Thank you.
I think
Martin, before you answer, since you're running out of time, can I just take the last two questions?
Yeah.
Then you can maybe combine the answers.
Okay.
Please, there are two more questions. So, because we're supposed to finish at 6:30, so.
Okay.
I spoke too long. Apologies.
Yeah.
My name is Asha Hemrajani. I have two short questions. I wanted to, you presented on your summary slide and in one of your earlier slides, you talked about possible solutions. But how can that sound economic thinking that you mentioned, can that be translated into practical political actions, become operational politically? I wanted to know your views on that. And well, in relation to that, how they can be implemented by politicians who may have vested interests? That's my first question. And the second question I had was, you briefly mentioned earlier in your remarks that you had a set of rethinks between your previous book and this book. I'd like to know a little bit, if maybe you could focus on 3 different areas of rethinks that you had. That'd be great. Thank you.
Hi, evening, Mr. Wolf. I'm Wei Long. I have 0 economic credentials, but I do feel guilty for not doing enough to charity. My question is on basically inflation targeting, be it Abenomics or otherwise. Because, when you increase inflation, you're basically telling people that their savings are 0. There are 2 options of this. One, they invest in some equity which makes the equity market more reckless CEOs, richer, whatever, inequality increases, and from all of that also is retirees get poorer because their savings are diluted. The result, ultimately down the road, kicking the can, is going to be a big blow up in government welfare spending. And with greater inequality or greater instability. On the nice side, we have people doing Occupy Wall Street movements, which are very kind and courteous, so be it in Hong Kong. On the wild side, we have ISIS, and this is going to be a big problem. So I cannot understand what's the point of inflation targeting if in future the result is going to blow out in our face. Thank you.
How do you defend inflation?
Okay.
You got some very good questions.
Okay, I'll try and do this in 4 minutes, and I apologize. I apologize.
Make it 5. I will be generous.
Okay. I just wanted to cover the range of the book and to get people interested, because really the arguments you have to read through and work through yourself. I think debt restructuring I think it would have been relatively easy, but it is now relatively easy. There was a huge legal problems and political problems, notably so in the US, when this proposal was made. When the idea of debt restructuring was first floated in the US in 2009, it led to the creation of the Tea Party directly, which is, I thought it was astonishing. I still can't get my mind around it, that the great popular protest is that they were restructuring the debt of poor households who clearly couldn't repay, but nobody really complained about, not really in the same way what was being done for the banks. It's just amazing. But in theory, at the point at which all of our countries were providing huge funds to the banks to recapitalize them, they could have said the quid pro quo is a process of restructuring underwater mortgages. And the best way to have done that, in my view, would have been to have a program, I don't discuss that in this book adequately, in which some part of the debt was simply converted into equity owned by the banks. So the equity was shared between the banks and the household, and the mortgage per se was reduced to something that was affordable. And the desirability of this is that we know that if people are forced into foreclosure, there's a huge loss of value. It's actually in the interest of people to do this. Now that, of course, means changing bankruptcy procedures and encouraging this. It's what they did, actually, interestingly, when saving the motor car industry in the US, but didn't work in the same way for housing. And nobody outside the US really did this at all. And that means that all the households are left still with their debt in Spain and Ireland, and that is a tremendous drag. So I think that the right thing to have done was, as a quid pro quo for the support for the banks, was a clearly defined program of mass restructuring of debt. Now it's very late. A lot of this has happened, but in some European countries, I still think it's quite a high priority, and something they could consider or could have considered as part of this bank restructuring they're now doing. Helicopter money. The simplest way of doing this would have been to say, and I made this recommendation, terribly unconventional nowadays, is that the government puts forward a huge investment program financed by bonds, government bonds, and sells them on the market, and the central bank buys them. And the point about this is compared to what we're now doing. What the central banks are now doing is creating a staggering amount of money in order to manipulate asset markets. That's essentially what they're doing. And to get that to affect income and spending, they have to do an immense amount of asset purchase in order to change income and spending, which is what they're really trying to change. What they're trying to make is people spend. And they do it indirectly by changing asset market values. And one of the most clearest facts about our economies is you need immense, and I do discuss this in the book, amounts of asset price manipulation, raising asset prices, to get relatively small amounts of additional spending. So my argument is, why not do it directly? And the way you can do that is, instead of supporting asset markets, you do the deal with the government of spending. So to take the Japanese case, instead of printing 80 I can't even get my mind around 80 trillion yen to buy JGBs, which yield not much. JGBs and money in Japan are virtually perfect substitutes. They're not going to achieve very much this. They could have done a small fraction of the 80 trillion and simply said to the government, run a deficit of 15% of GDP for the next 3 years, we'll buy those bonds, and they would end up with less bonds. Right? They would have much less bonds, and there would have been a lot of spending. And the simple sentence in Japan, they've already built all the bridges to nowhere. The simple way to do this is not to raise taxes, but to cut them. And raising the consumption tax was mad, because the one thing they need in Japan is more consumption, not less. So that's the way I would have done it. How would you translate this into operation? The policy system is not very open to new ideas, for two reasons. It's not very imaginative. There's a traditional way of doing things which is the right way. Everything else is unsound until you finally realize it's the only sensible way. And people only change their policies in a fundamental way when it's obvious they're failing. And the policies they've introduced this time, they were better than the 30s. We've done much better than the 30s. We haven't had a Great Depression. But the policies they worked this time have worked well enough to stop complete collapse and not well enough to get a real improvement. But that has not been sufficiently disappointing to force people to a reconsideration of the policy system. We're still basically using the policy system I've described. I've argued in my book, the way I think about this, which is I think the way much better people than I have in the past, is you put forward new ideas, you argue for them, you get them into the public realm, you hope people will read them, and so the next time round we will be prepared, more prepared. People will be more aware of the possibilities. But I don't expect any, the amount of groupthink in the policy system is staggering. And to some degree, the very fact that everybody's talking to everybody else in all these G20s and APEC and in Basel on the regulatory system means they're all forced to agree to do essentially the same thing. And once you've all agreed to do the same thing, nobody dares to do something different. The one real innovation in this, I think, the real innovation was the Americans are always the most willing to do what they think once they get themselves organized, because they really don't care what anybody else thinks. They're the one country who really doesn't care. So the stress test system, which Tim Geithner introduced in 2009, was astonishingly, to my mind, surprisingly successful. And everybody else has since adopted it as a way of really getting to grips with the financial sector. And though this didn't solve the demand problem in Japan, in the US, or the inequality problem, it did solve the question remarkably quickly of whether people had confidence in banks. They got that fixed. And that was because there was a policy innovation, and then something new has happened. I think one of the most important things is to try to encourage government, and I have this in my book, to do things, to experiment. Not to do all of them the same thing at the same time. And I think very importantly, perhaps the best, Kishore will love this, the best lesson for emerging economies from this whole crisis is to realize that the developed countries do not know what they're doing, because they don't, and to think for themselves. They have, by now, a vast number of very well-trained economists and policymakers, and they can think it out for themselves, and they can take it for granted that what we're doing is likely to be a mess. What have I rethought? The most important thing I've rethought, because I hadn't really thought about it rigorously enough before, is the link between macroeconomic developments and the stability of the financial sector, and the capacity of the financial system to generate debt leverage sort of more or less without limit and then blow up. And I have a large chapter which discusses my different ways of thinking about that. But I think it's so I won't discuss three. That's the single most important thing I have learnt. And that leads to some very dramatic conclusions. Finally, on inflation targeting, well, I don't think it has all these terrible consequences. I think the idea that inflation targeting would lead stability on its own was obviously a mistake. It's quite possible that the target we have given was a mistake. But the idea that people should have be able to foresee to some degree the value in money over time seems to me pretty indispensable, because the provision of money is perhaps among the single most important functions of governments. We could change that, but basically the provision of money is a function of governments in the modern system, and they need to be disciplined in doing it. And inflation targeting is the least bad mechanism I think we have to discipline it. I'm not personally in favor, though lots of people are, of going back to the gold standard. We can have a long discussion of why I'm not. I do discuss it in the book. And I don't think we can go to world money, because I think the Eurozone experience has clearly demonstrated that money is a property of a sovereign state. It's linked with a sovereign state. So having an independent central bank that targets inflation is not a bad idea, as I would have probably a higher target now myself. But what we've got to get away from is the idea that just because we've got targeted inflation successfully, we will therefore have a reasonably stable economy. That view is, we now understand, I think, clearly wrong. And that, I think, covers more or less those questions, and I only ran over a few minutes.
Well, I am sure you will all take away many lessons from Martin's remarks today, but I hope you'll at least take away one important lesson, that more crises are coming. You need better policy makers, and therefore you need to support schools of public policy. Thank you, Martin.